Yep. So early retirees with kids may face substantial expenses during retirement that traditional retirees have already dealt with, things like kids' college tuition, maybe buying a home,
Yeah,
whatever.
yeah.
How should early retirees plan for these type of expense milestones in terms of their asset allocation and safe withdrawal rate planning?
Well, I mean, I can tell you what we do. So we have a 529 college savings plan, and we still contribute to that. So we have a 7-year-old daughter, and we have been contributing into her college savings plan since she was born. Actually, I contributed into a plan with myself as the beneficiary
Mm,
before she was born.
mm,
And then when she was born, I changed the beneficiary from myself to my daughter. Very
mm.
easy to do. I think it's you just have to sign one paper and send it in by mail. Probably now you can do it online. And this is what we do, right? So this should hedge the college education, and yeah, I mean, there's a saying in German that says "small children, small worries," which by extension means bigger children, bigger worries. The worries and the expenses, by the way, too, they only go up as the children age, and that's definitely the way we plan. So I certainly think that we may probably never completely
Mm.
uh, reduce our expenses that come from our daughter. So here's another example. So what if our daughter is done with all of her education, right? So then it comes so paying for a wedding, right? Then helping with the down payment, and then she moves somewhere, and it's again in a high cost of living area, right? Our whole point about early retirement was, hey, we can afford early retirement because we don't have to live in San Francisco anymore, right? We can move to Southwest Washington State. It's very affordable here. Houses are relatively inexpensive. You can get twice the size of the house for one-third the cost relative to San Francisco. So is a perfect. But we might have to move back into a high cost of living area again later in retirement, right? And then high cost of living area is not just the cost of living; it's also the taxes. Or, I mean, obviously, we could also then just say, well, sorry, we can't afford it. So we'll just have to visit only a few times a year. But yeah, I mean, there are a lot of potential expenses basically through the entire lifespan, right? And then you have grandkids again. Then that potential expense channel starts.
So is I
So
guess the way to handle that, just factoring into your calculations
yeah,
to these expense milestones and then sort
yeah,
of trying to
yeah,
amortize toward them. Because
right.
unlike the retirement date for the early retiree, which may have some flexibility on the left or the right,
Hmm.
the kid is going to go to college, presumably.
Right,
Let's assume that will be the case, and that's generally going to happen like around a fixed date, around
right, right.
18, and she's going to end around 22. So those dates are, relatively speaking, less flexible, and so
Yeah,
is and it's going to spike during those periods, as an
right,
example.
right.
So is the right way to think about that just to factor that into your budget and amortize toward that so that it doesn't actually hit you as a spike?
Well, I mean, I'm not amortizing anything. So what I would assume is that um, so exactly x plus 1, x plus 2, and x plus 3 years into retirement, we have more expenses because we're going to pay for the kids' education. But then again, I and then but effectively what we'll do is, I mean, we'll just, as you said, we amortize it. We put money aside every month, and then of course people are going to say, wow, but what if there's a stock market crash right around the time she starts going to college? And well, then I'm just going to say, look, yeah, kid, we are going to pay you one-fourth of what that portfolio is worth right now for your college expenses. If it's more, that's fine. Then we don't even have to withdraw it all, and we can save it for grad school or for the grandkids education. And if it's less, well, then guess what? Then you just get a student loan, right? It's not like I have to hedge this exactly down to the last penny. I don't even know what college she will go to.
Mm-hmm.
So we live in Washington State, so there's some good state schools. University of Washington in Seattle and Washington State in Pullman. These are both really, really good public universities. I hope she'll pick one of them and not get blinded by the expensive private universities. And if she goes to those places, I mean, even at 7 years old, I think we already have more than 4 years worth of tuition at 7 years old. And well, if you factor in living expenses and some other expenses, housing and stuff, maybe that adds to it. So I think we're good with that. As I'm more worried about that long-term prospect where we say, well, now we feel compelled that we have to move to a higher cost of living area again. That's probably the more unpredictable and also expensive risk on the horizon there. So, but college, and again, if you really want to commit to exactly hedging a certain amount of money, so then you get into the issues, right? One is, again, the glide path. What kind of asset allocation do you choose along the way, right? Do you want, so right now in our 529 plan, we are 100% equities, right? Because it's so far in the future. And again, if the money is not quite enough, well, sorry, kiddo, you just have to chip in a little bit yourself. But I mean, I'm pretty confident that this is actually more than enough for college, plus maybe even 2 years of grad school by the time we get there. And now, is it going to be enough for private college and then medical school afterwards? Probably not. But then we'll have to check if and how we want to do that. But yeah, and then again, so you don't have to help your kids with the wedding. You don't have to help your kids with the house down payment. And I feel a little bit compelled to do so because, I mean, I look at what the federal debt is doing right now, and so somebody has to pay for all of this, and it's our kids' generation, and so I feel that that I'm probably compelled to help her a little bit get a start in life. I don't want to spoil her, obviously, right? You don't want to be these helicopter or snowplow parents that take care of all potential obstacles. So you have to find a fine balance there. But I think that, for example, so imagine our daughter finds a job in one of these high cost of living areas, right? And she pays rent there, and the rent is so high that basically her entire salary goes towards the rent. She will never have enough money to save for a down payment, and she will be on this financial hamster wheel forever. Yeah, I mean, I would feel guilty if I didn't help her out a little bit, and that potentially could be way more than you would ever spend on a public college education. So I mean, we definitely think that there might be some big expenses in the future, and these expenses, they're so much higher than, I mean, our daughter she's not going to eat much every month, right? I mean, if you look at the food budget or clothing budget or even entertainment budget, it's what we spend right now, right? I mean, we can buy clothing for her at Walmart, or we even get some stuff secondhand. She's not complaining about that. Now, once she gets older, that's going to be a little bit more expensive. She might have a more expensive. So this is where that phrase comes from, right? Small children, small worries. Everything just gets more expensive and more worrisome as kids age, so I have absolutely no illusion that for some reason we're going to save money once the daughter gets older. It only gets worse. But again, there are ways to budget for it, right? I don't necessarily think that our spending path will be flat throughout our retirement. I think that it might be flat. It might be slightly increasing until we reach some sort of a traditional retirement age. And yeah, there could be in the future, there could be some time when we start scaling down a little bit because we travel less. But then that could also coincide with the time when health expenditures and nursing home and long-term care and stuff like that hits.
So I guess as you were thinking about them planning for this, did that just factor into how large your portfolio you believed had to be to even get to the retirement date?
Yeah.
And maybe in the early years, children are small, then the withdrawals are under withdrawn because they're going to be balanced out in the latter years with more aggressive withdrawal. Is this sort of the, at least roughly the framework in which you
Yeah.
were thinking?
Yeah. So, I mean, this, again, even with completely flat returns. So, and then again, flat withdrawals. Flat means you take your current baseline budget and you simply adjust it by inflation. So in real terms, it's flat. In nominal terms, it goes up just with inflation rate. I was always under the impression that I was always planning for the prospect that our expenses might even go up a little bit as we age. And so you can factor that into safe withdrawal analysis, right? So you can model some additional cash flows later in life to hedge for nursing homes. So it turns out that if you retire in your 40s and you want to hedge some huge expenditures for nursing home, and we're talking about $150,000 extra, right? It's not $150,000 period, but $150,000 extra on top of your baseline expenses potentially, right? Even though it sounds like a big number, it's not even going to make that much of a difference on your safe withdrawal rate today, because that is so far in the future. And nobody knows what the CAPE at that time will be. Nobody knows. So there's the near-term expenses. They are the big troublemaker from the sequence of return risk point of view. But what happens 40 years down the road in retirement, it's not really going to make that much of an impact on today's withdrawal rate, on today's safe and fail-safe withdrawal rate. So again, I mean, I've looked at all of these different things that can go wrong with your expenses. So these big one-time expenses, or even the ongoing expenses very late in retirement, yeah, I mean, you want to kick the tires and check if what difference that would make. It's probably not going to make that much of a difference. What is much more insidious and dangerous is, say, a slow creep of your expenses going up by, say, 1% every year, right? So you say, well, because everybody else around you, right? I mean, they are adjusting their spending not just in line with inflation, right? They are adjusting their expenses more in line with per capita GDP growth, right? And that's probably somewhere in the neighborhood of 1%, maybe a little bit more than 1%. And maybe as a traditional retiree, you can get away with, well, I'm not going to do the nominal GDP. I'm just going to go with a CPI. But if you're a very early retiree, right, and you, for 40 years, everybody else around you is raising their standard of living by 1% every year, and you don't, well, after 40 years, you've fallen behind by quite a bit, right? And so the more insidious problem in your safe withdrawal analysis is more of this slow creep up in your expenses, and it may only be 1% or so per year, and from year to year you hardly even notice the difference. But if you do this every single year, say to keep up with the Joneses, keep up with your neighbors, and you keep up with your not early retired relatives and friends, then that definitely makes a big difference in your retirement finances. The fact that you just keep raising faster than the inflation rate your withdrawal amounts. So that's the more insidious problem. Expenses later in retirement, 20 years down the road, is probably not the biggest problem. And if you have them, yeah, I mean, certainly. So I have this Google sheet where you can model your own retirement simulations. Yeah, I mean, you just model that as an external cash flow need, or it could also go the other way around. I mean, you could say that at some point you will be eligible for, say, for a company pension, right? You can take that out as a lump sum, so you put that back into the portfolio. So it's really important to model these additional flows, whether it's consumption creep or the big cash flows, say 10 years, 15 years in retirement. as a college education. And yeah, I mean, we account for that, and that's one of the reasons why we were very conservative with our portfolio and our. So I guess we could have retired already in 2016, and we waited another year, 2017, and said, oh well, let's just give it another year, and then in 2018 I finally retired. And in hindsight, you could almost argue it might have been a year or two too late. That we could have retired a little bit earlier, but some of these spending uncertainties, they definitely convinced us to wait a little bit longer.
Yeah, it does make sense. And actually, it sounds like the Google sheet. If you it sounds like this this cash flow modeling Google sheet. Share it with me, and I'll link to it in the show notes. I think that would be helpful to folks.
Yeah, yeah.
I wanted to talk a little bit about the yield shield. So this is one popular theory I know you feel pretty passionately about for mitigating sequence risk. It's to simply hold high dividend yielding assets like dividend paying stocks. And if you hold, to use industry jargon, if you hold dividend kings or dividend aristocrats, which are two flavors of dividend stocks that have a track record of increasing dividend payouts pretty consistently, then perhaps you reduce the risk that a dividend gets cut or suspended during down markets. And the theory is that if you can support your retirement cash flow needs solely using dividend payments, then you don't ever need to worry about sequence risk because you never need to sell any principal. Now, you've written in blog posts that concentrating your holdings in dividend stocks or dividend yield index provides maybe a bit of a false security and doesn't even alleviate sequence risk necessarily either. Can you explain the intuition behind why you think that? Why holding, say, a plain vanilla S&P 500 index fund might actually be a better safeguard against sequence risk, even though it doesn't pay a high dividend yield?
Okay, so first of all, I mean, there's so many different facets of this issue, and I have written 4 blog posts on this. So a sequence of return series 29, 30, and 31, they dealt specifically with the yield shield and why it hasn't worked so well. And then part 40 deals particularly with, well, how about just looking at the equity side of the portfolio? Can we just say, well, we just live off of the dividends, right? We never touch the principal and just live off of the dividends. And so talking about the yield shield, so before I even get into the details, so we have to get one thing out of the way and really clear. So when somebody makes a claim that, okay, here is a shield, it implicitly, it's probably even explicitly, they made the case this is something that's shielding you from sequence risk, and it's marketed as something that helps you every time. So when I want to falsify a statement like that, all I have to do is I have to come up with one example where it didn't work. Right? I don't have to prove that this fails every single time. All I have to prove that this needs to be debunked is that, well, here's an example where it didn't work and I'm done. Because I got a lot of hate mail. This was the only, as I've written 200 blog posts. I've gotten, I don't know how many, maybe 10,000 comments on all the blog posts. I've gotten countless emails. They were all very friendly. This was the only blog post where I got hate mail. Very nasty comments and some really threatening even emails. And so I must have stepped on some people's toes there. But again, this is basically the straw man argument that people make, is that, oh, so you are saying that this fails every single time. And oh, here was an example where the yield shield actually performed better than just the plain index market portfolio. And again, I'm not saying that the yield shield fails every single time. I only showed that it failed that one time. And by the way, so I wrote this article in 2019. I should probably do an update just to shake up things again a little bit with the comments and the emails, and show that, by the way, it also failed in 2020. So I was surprised by it, because I thought that, well, I mean, this might be something that, only very occasionally failed. And since it failed in 2007, 8, 9, I almost said that, hey, I mean, now is maybe is a good time to implement this, because I mean, what are the odds that it fails twice in a row? But well, guess what? It failed twice in a row. So 2020, it also performed very poorly. And again, so this is the first thing I want to say. In order to prove that, in order to disprove the claim that this is a shield or some kind of a hedge against sequence risk, I simply have to prove, okay, here's an example where it failed pretty miserably. And so this is the first thing I want to say. The second thing I want to say is that for 2 out of 3 subcomponents of the yield shield, I would never ever claim that the failure is because of the dividend yield, right? So I'm not saying that the failure, because there is higher dividend yield, that's why it failed. I just say it failed because of something else. It failed despite the higher dividend yield. And then, by the way, when it worked better, when the yield shield works better than the passive index portfolio, it's also not because of the dividend yield. It's also because of some other factors. So this is true for 2 subcomponents of the yield shield. So the first subcomponent is that within the U.S. equity allocation, you just look for higher dividend yield stocks, and they didn't even go to the dividend aristocrats or different dividend lions or something. There's some different, more active dividend yield portfolios. You just look at the, I think there's a Vanguard high yield dividend fund. I think it's ticker VYM. And that has slightly higher dividend yield. And then they replaced part of the domestic portfolio with the VYM. And well, it turns out that that was actually not the worst offender during 2008, because the VYM roughly performed in line with the S&P 500. And it was actually a little bit worse than the S&P 500, but I'm not going to make a big deal out of that. But what I'm going to make a big deal out of it is that despite the higher dividend yield, it did not help you. And the reason is that, look, everybody, especially in the personal finance community and especially in the FIRE community, they all pontificate every day how bad it is to do active stock picking, right? And now suddenly they say, well, now we pick stocks based on the dividend yield, and they are supposed to do better than the overall index. And so there's just this logical inconsistency in here, right? Because so to me, I look at the total return, right? And what turns out that if a stock has a higher dividend yield, then my first inkling is, well, yeah, they pay higher dividend yield, but then the price return is also going to be lower. They'll have lower capital gains, all else equal. They'll have lower capital gains to make up for that dividend yield. You can't just say that, okay, we have 2 stocks. One has a dividend yield of 2%. The other one has a dividend yield of 4%. And you're telling me that the 4% dividend stock is going to outperform the 2% stock by 2 percentage points every single year? No.
Right.
I mean,
it should be arbitraged away.
It should be arbitraged away. And I mean, in fact, I mean, the same people that make all of these claims about how bad active investing and stock picking is, they always make this case, well, yeah, I mean, markets are efficient. And now if markets are slightly inefficient, right? Because it takes a little bit of time and effort to dig through hundreds of pages of balance sheets and cash flow statements, right? Do you have an accounting background?
I'm also CFA.
Yeah. See, so you could at least make the case that the active stock pickers that do all of this really careful work for the stock picking, and they go through company statements, and they talk to the CEOs and the CFOs, and they dial into the earnings calls, and they gather information that way. I mean, at least you could argue that, well, a lot of that information, yeah, it's out there, but it's not that easy to gather it. But the dividend yield is probably one of the most visible and obvious characteristics that your corporation has. And then suddenly the same people that are poo-pooing active stock investing and stock picking are then reverting to active stock picking. And then the measure that they use for the active stock picking is is a measure that even grandma can look up if she goes to Yahoo Finance. And so it just doesn't make any sense. So for me personally, again, I'm not saying that the higher dividend stocks are going to underperform. I'm simply saying that they're not going to outperform, or they're not going to consistently outperform, or they will outperform during certain market environments and they will underperform during other market environments. But please don't call it a shield, right? Nothing is going to shield you here. It's like saying it's like marketing a parachute, and it works half the time. And then I pointed out that, well, this parachute unfortunately killed the jumper, and under this environment, it didn't work. Then people say, well, yeah, but in this environment, it did work. I said, well, it's still a pretty bad parachute if it fails X% of the time. And by the way, it's not my job to prove that the parachute fails every single time. I pointed out that, well, out of the last 5 bear markets, I mean, certainly it failed in 2007, 8, 9. I don't have enough data for all the different instruments they used to go back all the way, because I don't have preferred share data, and I don't have all the indexes that they used. Going all the way back through all the recessions. But certainly over the last 5 recessions and bear markets, I identified one where it doesn't work. There's probably another one where it would have failed again. But I just, to be generous, I say out of 5, 1 failed. And then, well, guess what? Now we have the 6th bear market. And in that bear market, the thing failed again. So we just went from a 20% failure rate to a 33% failure rate.
And just you say fail. How do you define
so, I mean, a failure rate, so I looked at, so imagine you had retired at that date. There are 2 people. One just did a plain 60-40 portfolio, 60% S&P 500, 40% 10-year treasuries. And the other one did all of these bells and whistles. So who came out ahead? And by the way, it would not have failed in the sense that, well, you ran out of money, right? Because as I said, the 2007, 8, 9 bear market, as bad as it looked in real time, from a withdrawal rate and sequence of return risk point of view, it wasn't one of the worst bear markets. So. Mm-hmm. So that's just for full disclosure there. So when I say failure, it means it did worse than the plain vanilla passive portfolio. So this is the first element is you take the U.S. stock portfolio and move it into higher yielding U.S. stocks. And then again, I mean, I looked at some of the more active dividend portfolios, U.S. dividend portfolios. So there's the Noble, N-O-B-L, which has a relatively short history. But again, so that was not available in 2007, but there was a different one. I think it's one of the State Street ETFs that did a little bit better, but again, it's not like anything that will save the day. So my lesson is that it was a bit of a hit or miss, right? Sometimes it works, sometimes it doesn't. But since, I mean, these are all still U.S. corporations, they're all still constituents of the big U.S. indexes. Yeah, it's a bit of a hit or miss. It's a bit of a crapshoot. But the deviation between investing in U.S. dividend yield stocks versus the broad market is not huge, right? I mean, we're talking about a relatively low tracking error between the indexes. The bigger tracking error, of course, is if you shift from U.S. stocks to non-U.S. stocks. Right? So now it's the same asset class, but it's a different universe. It's a different countries. You have FX risk, right? You have the exchange rate risk. You have the risk of a lot of non-US stocks have very different sector compositions. I mean, there's some people who say that, well, the fact that European stocks have been underperforming recently is simply because they don't have enough IT exposure. Right? If you look sector by sector, the underperformance of European stocks is actually not that significant as if you look at the overall index. And so a lot of the underperformance comes from different sector composition. And then on top of that, sometimes the FX movement goes in your favor, sometimes it goes against you. And so, I mean, you can point that, for example, 2001, the bear market, every country went into a bear market, for example, right? I mean, the bear markets, they happen everywhere, in Europe, in Japan, in Australia, New Zealand. It doesn't matter where you are. So everybody gets hit with the bear market. There's actually not that much diversification during the bear market, right? Because the correlations, they all go to one. Everybody just dumps every stock worldwide. It's not just in the US. But there is some diversification for the subsequent recovery. Because, for example, the recovery that followed after the 2002, 2003 bear market bottom, the recovery in the mid 2000s was actually much better in the non-US stocks. So again, the non-US stocks did a lot better during that recovery, but they did a lot worse than during the recovery in the 2010s. And again, it has nothing to do with the dividend yield, right? So the rationale in the yield shield is, you should invest in non-US stocks because they tend to have higher dividend yield. And again, I mean, in the times when it works, yeah, it works, but it's just because they have different sector compositions. You might have had good FX movements during the 2000s because the euro appreciated a little bit. And it had really nothing to do with the dividend yield. So again, I'm not saying that the yield shield does not work because of the higher dividends. It's neither because nor despite. It just doesn't work because of some other factors.
So it's like if we redefine the yield shield, don't call it a shield, but just call it a strategy where what we're trying to simulate is the thing that we described earlier, where as long as you don't have to draw down the portfolio, then the sequence risk is mitigated. It doesn't matter if the good returns or the bad returns are first or second, and the opposite is comes later. You're just trying to avoid that double dip where you have a bad return environment and you have withdrawals on top of that. And the way you hedge against that is by taking a withdrawal from the dividend, even if that comes at the expense of some of the total return. Because I agree, like by definition, a company that is paying out a high dividend, almost by definition means it doesn't have as good capital investment opportunities. So what do I do with the cash? I'm going to pay it out in the dividend.
Yeah, but even that doesn't work. So I
guess what I'm getting at is the risk that in this definition we're trying to mitigate is not that you're trying to outperform this comparison portfolio, but rather that you're just trying to avoid running out of money. Because the average retiree, I think, who is not sort of steeped in like financial research, isn't thinking so much about like, I want to be the best possible performing portfolio of all of them. They just don't want to run out of money because they don't want to, be.
Again, let me stop you there. So, but even that doesn't work.
Okay. All right. Tell me.
The reason is that obviously dividends will be cut. Even the ones that are not cut, they may not keep up with inflation. The principle of the stocks that you say you will never touch, well, there's no guarantee that principle will stay the same. It will go down. It might move sideways. It might not keep up with inflation. So, I mean, one little case study I did was because this is one thing that people always bring up. Oh, Australian stocks. Australian stocks have fantastic dividend yield. They have 4% dividend yield. And let's just put all your money into Australian stocks. You get a 4% dividend yield. Never have to worry about sequence risk again. Well, I did the simulation. Well, if you had done that in 2007, well, first of all, the stocks would have, your portfolio would be down, both in nominal and real terms. And then even the dividend income is also down because, well, guess what? The Australian stocks probably still pay the same 4% yield, but they also pay the 4% off of a lower base. So your dividend income also declined. So it's not that easy. Or I mean, even in the US, right? I mean, you look at some of the highest dividend yielding companies. Now, somebody in the comment section made the case that right at the time when I wrote this, there was one very extremely highly a very extremely high dividend yield stock. I'm not going to name the name, but it's in the business of providing cable internet services, both businesses and households. And that had a 13% dividend yield. And well, guess what? Maybe 2 or 3 days after I published that, they announced, well, we're going to cut our dividend by half. So again, even this whole, well, it's better from a cash flow point of view. It's not going to work that well in the sense that you might replace the sequence of return risk with basically sequence of dividend income risk, right? Because it means that if the stock market does well, then your dividends are going to increase too. Or if you have a bear market short term, I mean, dividends will be cut, right? I mean, there are still some companies that used to be some of these dividend aristocrats as of 2007. Well, they have completely cut their dividends, or they cut the dividend down to, say, I don't know, a symbolic 1 cent per share. Again, I'm not going to name any names, but some financial institutions, obviously, they did that. Part of it, they had to do it just because the cash flow problems. Part of it is because of the whole regulation, what came out of the global financial crisis. They're probably not even allowed to pay out much in dividends in the years. And well, guess what? I mean, I guess they got used to that cash flow arrangement. Hey, if we don't pay out as much in dividends, we have more money for investments, and we have more retained earnings that we can use for acquisitions and capital expenses. Even though I guess capital expenses not that big a deal for banks, but they probably got accustomed that, hey, I mean, this is really good. We don't have to pay out as much in dividends. We just do the retained earnings thing. So we actually prefer that over paying out a lot of dividends. So I mean, and then again, of course, in hindsight, you could have always said, well, yeah, I mean, you could have just avoided that. But who knew in 2006 and 2007 that the financial sector is going to get hit so badly, right? So
let me ask one question around this, which is like, okay, if an investor focuses on the dividend kings, which are the dividend, the universe of companies that have paid 50 years of increasing dividends without exception, and they tend to, if you look at the actual names, they tend to be in very defensive industries, industries that are, you know, like Procter and Gamble, or like utility companies, where you need to consume the thing regardless of whether the market is up or down, because, you know, you need to live like a human being. And if you focus on the dividend kings and you build a portfolio around that, again, the goal you're trying to solve for is not that you're looking for 100% success or even performing better than an alternate, you know, 60-40 or, you know, passive index portfolio, but just that the only thing you're trying to solve for is reducing the risk that you will run out of money. Is it still the case that you say that still it does not achieve that goal better than some of these other strategies?
Yeah, I mean, so the only ETF where we have some so if we have the VYM, which is not the dividend king, which is just a broad index. You just allocate according to dividend yield and nothing else. There's no additional, what I would call, quality screen, right? It's not just the dividend, but also the quality and the consistency of the dividends. There is a fund by State Street, and that has a ticker SDY. And that has a long enough history, and there is an additional quality screen. And yeah, with for full disclosure, that did a little bit better than the S&P 500. So if you had replaced your 60% S&P 500 in your portfolio with that SDY fund, you would have done a little bit better in 2008. I mean, not remarkably better. So it's not that this would have saved your butt, but it would have done a little bit better during the 2008-9 bear market. But guess what? It would have done very poorly in 2020. And there's the other fund, but unfortunately that doesn't have a long enough history. That is the NOBL. I think it's a Power Shares Dividend Aristocrats Index. That got completely hammered in 2020. So that did not as well as the S&P 500. That might actually still be down for the year. I have to look up the numbers, but I mean, you can go on Yahoo Finance and check that out. So it turns out that in 2020, well, what were the highest performing stocks in the S&P 500? It's the zero dividend payers. Yeah, it's the Amazons, It's
For sure. I mean,
it's the
that is
Googles.
truly a black swan event. I guess what I'm wondering is like, okay, if I'm your retail investor trying to think about how I can do early retirement, and I say, well, I read the Trinity study and it says 4%, 97% success rate, but I know that's not going to be true going forward, because if you actually look at an updated Trinity study that accounts for, say, the more recent 20, 30 years of data, then you see that 97% is drops in many cases, like maybe 60%. It's like not very comforting.
Hmm.
But if I shift my strategy to a dividend king strategy, and all I'm trying to beat is that 60s, mid 60s%, I'm trying to just get that higher. Does it increase the chances that happens?
So again, I mean, so that means you have to believe in stock picking, right? So I think people have this. I don't know if there's a technical term for it, but I call it the all else equal fallacy, where people say that, look, I have two stocks, they have different dividends, and the dividend is something that is really tangible. You observe that, and then the price return is something extremely uncertain. And because there's this great uncertainty, the best initial assumption is actually not a very good assumption, but the best initial assumption that illiterate people would do is that because I have no clue about where the price return comes from, the best initial assumption is that I assume the same price return for both stocks, and well, one has a higher dividend yield, the other one has a lower dividend yield. Boom, there we go.
No, but so I'm saying not those people. Let's take those people aside, and let's say the investor accepts that the price return will be lower because it has to be.
Yeah.
And you take away the stock
okay.
picking risk, or I guess subjectiveness, by just saying I'm going to build an index, a market weighted index based on dividend kings, and I'm not going to try to be an active picker. I'm literally just going to build a passive index that follows the market weights of the dividend kings, something like this. So you can make it more mechanical, and you are acknowledging up front that I'm willing to sacrifice some price return, because what I'm solving for isn't the highest return. What I'm solving for is avoiding running out of money.
Right. And then again, I mean, if the total return is the same, then my simulations will give you this exact same outcome for the index return versus the dividend return. Or you could go the other way around and say, well, if I strictly withdraw only the dividends and I keep the principal in place,
yes,
then you probably do better than with the index portfolio where you strictly take out a certain amount of money. But then the problem, of course, is that you also withdrew less during the crisis, because I can guarantee you that some of the dividends will eventually be cut, and this is one of the problems that you have these dividend aristocrats, and they have a very long history of paying dividends, and of course every stock has a very long history of paying dividends until it stops paying dividends, and then, well, guess what happens to a stock that is even at the brink of cutting their dividends, right? They know they'll fall out of the index, and then they have to make this conscious decision. Look, we have this very long history of making dividends. They will have to pay out dividends, and they are burning cash at a time when this might be a good time to preserve some cash and do some investments, right? Because this is now, money is cheap. And we could do some acquisitions with that money and buy other assets for pennies on the dollar, but we're wasting that money on dividends. So I just, this whole dividend yield thing, I mean, maybe I'm too much of an economist, right? There's this saying about economists that walks past $100 bill on the street and walks past and says, well, it can't be a real $100 bill. Somebody would have already picked it up, right? So, I mean, maybe I'm becoming now so rational and so much in favor of market efficiency that I'm missing something. But I think that there are the reason why the dividend yield indexes have not done so well. I mean, of course, you could argue that this is a sector issue, right? If you look at the sector composition of both the dividend yield, the VYM or the SDY or the NOBL, is very different sectors, and you miss the big run up in tech stocks during 2020, um, and um, and then you potentially also, I mean, you got hammered obviously with these dividend paying stocks, right? Because it's energy got clobbered, right? And energy got clobbered also in 2008-9, I believe, right? I think some of the very big dividend payers. So financial, obviously, right? That used to be a traditional high dividend payer, low price to earnings ratio, high dividend payers in the 2000s. So the financial got hammered there, and yeah, I mean, you never know what kind of crisis, what kind of shape the next crisis is going to be. And I mean, I always say, look, I mean, I do the index rates, I'll be done with it, and if I do something else from the index weights and it works out really well, I think, oh yeah, look how smart I am. Well, maybe you're not smart. Maybe you're just lucky because you picked the right, you inadvertently picked the right sectors. And then yeah, I mean, I would also be afraid that, I mean, some of these traditional dividend payers, I mean, they have this really bad damned if you do, damned if you don't issue, this catch-22. When they get into cash flow problems, do we keep paying the dividend? We're just going to depleting our cash right at the wrong time, or do we cut the dividend and then our stock is just going to get clobbered because everybody's going to dump that stock, and then everybody who holds that stock in the Noble, until they announce the dividend cut, it's already going to go down in price because everybody anticipates the potential dividend cut. And then once it gets dropped from the index and everybody rushes and has to sell it, and then all of these passive index ETFs, right, they have to wait until it's actually announced. And then there's going to be a lot of people that can front run these big index and ETF reweights. I mean, there is, by the way, I think there is something of a stock picking alpha that people can still pick up, right? It's basically front running some of these index reweights. That's something that is traditionally done. I mean, I've never done it, and I think the company where I work, we never did that. But there are some hedge funds that do that, and they can make some money off of that by front running ETF reweights. Because ETF, the way the ETF is run, I think it has to be pretty explicitly stated what they do it and when they do it, and what are the rules there. And there's some smart people that look up these rules and they just front run the big trades that are coming from the big index players. But anyways, so as attractive and as reasonable and as logical as that may sound, well, it always circles back to show me the total returns. If this is something that will consistently beat the overall index in total returns, I would be on board in a heartbeat.
But the goal is not to beat the index. The goal is to give up some of the upside in return for mitigating the sequence risk.
Yeah, but again, you don't mitigate the sequence risk. The sequence risk is just going to hit you in a different way. Right. If you, I mean, for example, I wrote a blog post. So this is no longer specifically about the yield shield. So this is part 40 of my safe withdrawal rate series. It's exactly that question. What if we just simply withdraw the dividends? And I did it with the S&P 500, but I guess you can do it with some other index. But if the total returns are the same between the dividend portfolio and the S&P 500, it simply means that the sequence risk takes on a different shape. Instead of running out of money, eventually you run out of purchasing power in the short term. You just have to cut your expenses, and then if you have, for example, as your declared target. So, for example, you could argue that if you look at just the price return in the S&P 500, certainly over the last 100 years or so, just the price return, even adjusted for inflation, never dropped below the 100%. So you, over a 30-year window, just looking at the price return, you preserved your capital. And there might have been one time where it dropped a little bit below, but it wasn't much. So as a working assumption, so not only did you preserve your capital, but just purely through the price return, yeah, absolutely, you grew your capital over 30 years. So, but the problem with that is if you look at, well, how did the dividend income look
Mm.
along the way over the 30 years? Over 30 years, first of all, sometimes you start with very low dividend yield, and the dividend yield is so low that even I, as somebody very conservative, I would not pick a withdrawal rate that low.
Hmm.
And then, I mean, it's also volatile, right? The dividends, there's some year over year volatility. There's also some very long drawdowns. So if you look at the dividend income, I think it's between the 1960s and 1980s. There was something like a 30-year window where you were underwater. So you started with your withdrawals, and over the next 30 years, you were underwater and you would withdraw less than what you would have withdrawn initially. And again, I mean, that pattern, I don't have that same data for your noble dividend aristocrats or dividend kings. But I mean, I bet you some of that same pattern would have emerged there too. And it has to do with the fact that, yeah, the dividend aristocrats, they look good. If you had known 25 years ago who are the dividend aristocrats today,
Mm.
and you had invested in those same stocks 25 years ago, when potentially many of them were not even aristocrats yet, they
That's a
were
good point.
declared.
Yeah.
So there's a little bit of hindsight bias where they can show you these are the stocks we have in there, and then people look them up and say, oh my god, I mean, they all did really well. But the problem is there are a few stocks that dropped out of the index because they got clobbered in 2007-8, or they went out of business in 2007-8. And that is one of the problems. So again, if it all comes back to total return, and either you get clobbered with the sequence risk where you run out of money after 30 years, or you might have to cut your dividend income along the way. And so that dividend shtick just doesn't work as well as some people want to make it. But then again, I mean, I give you this, that dividend stock style bias, if you want to call that. I totally agree. I mean, on average, it sometimes works better than the index, and it sometimes works worse than the index. So it's a bit of a hit or miss, and there are some examples where it doesn't work. So they shouldn't call it a yield shield. Just before we finish up this point, so I talked about within the U.S. shifting into higher dividend stocks, then shifting from U.S. stocks to international stocks. That's also hit or miss. There's also, so that's the portion, that's a 60% portion, that's the equity portion of the yield shield. So, and I concede that, yes, I mean, it's a hit or miss, it's a crapshoot. Sometimes it works better, sometimes it works not so well. The fixed income portion, so when they start moving out of safe government bonds and into higher yielding bonds. Now, on the bond side, it is actually certifiably, it's going to hurt you during every single bear market, right? And so if you try to pump up the yield on the fixed income side, absolutely, that will hurt you every single time during every single recession. So that in the sense that maybe this whole stock market pumping up the yield is this is not the battle I want to fight, because there's some people that feel very passionately about the dividend side. So if somebody wants to do the yield shield and you want to do that only on the stock side, absolutely. I mean, you have my blessing. If it doesn't work out so well, don't come crying to me. If it works better for you in the next recession, you can say, hey, look how smart I am. But the one thing that will certainly hurt you during every single recession and bear market is pumping up the yield on the fixed income side. And so I had that little table in that blog post where I looked at the yield of different things that they want to put in the yield shield. So you start from the safest asset to the riskiest asset. So the riskiest one is preferred shares, right? So this is a hybrid between stocks and bonds. And so if you go along the line, so you start with government bonds, and then you do the aggregate bond index, which includes also investment grade corporate bonds. And then you completely drop the government bonds, you go only investment grade corporate bonds. And then you go a little bit more into the high yield sector. And then you do the preferred shares. The yield goes up, But unfortunately, also the correlation with stocks goes up. So you gain yield, but you also lose diversification with the diversification against your stock market portfolio. And that is definitely going to hurt you if you are right around the stock market share. So preferred shares got hammered really badly in 2008-9. Some of the high yielders or corporate bonds, they got hammered, and you get this dichotomy. The safe government bonds, they have start with the lowest yield, but they also perform the best during the downturn. And then the more you go into the high yield, the worse the whole thing is going to perform throughout the recession. And you have the same thing, right? Companies fail, all the yields go down in so the preferred shares. If you look at the dividend flows along the way, basically preferred shares, there's a lot more optionality. For example, if a company says it has a corporate bond and it stops paying interest payments on the corporate bonds, well, then it's going in default, or it's going into bankruptcy, basically. But on preferred shares, for example, you have a lot more leeway as the corporation. You could just say, well, you know what, it's a hybrid between stocks and bonds. We decide not to pay the dividend this quarter, and that definitely happened during the 2007 and 8 recession. So these kinds of assets, they get hammered really badly during recessions and bear markets. The same thing happened again in 2020. So there is definitely the one time where I could say that certainly on the fixed income side, the yield shield, not only will it fail once, which is really all I had to show, but on the fixed income side, it will fail in every single bear market. It will hurt you in every single bear market. So don't consider this a shield. Consider this just basically equity risk through the back door, because the higher you go up in the yield, the more hidden backdoor equity exposure you have in your fixed income portfolio.
All right. Okay. Well, spirited discussion.